What is up, YouTube? I just wanted to quickly address this for you guys. When I was making this video, I did not realize how long I was going to go on for and how long this video is going to end up being. So I'm going to end up putting it into two parts, and that is why you will be seeing me release two videos under the same basic headline. So went a little long on this one, but it's going to be super value packed. Hope you guys enjoy the video. Here is part one. What is up, YouTube? Daniel here with another stock market video for you guys here on my channel, Life with Dan. For today's video, we're going to be going over one of my top 3 favorite consumer product stocks that's out on the market right now. This is a company that's managed to have a record year, a killer 2020, even with everything that's been going on, even with the lockdowns, even with the fact that retail had that momentary shutdown throughout the year, which made it a lot harder for this company to sell its products. This company just reported their fourth quarter earnings last week on Wednesday, as well as wrapped up their fiscal 2020, and I could not be happier with the numbers that they put out and all the information that we get to go over today. We are talking about Sonos Company, one of my favorite companies to look into right now as a stock and as a technology company, just because of everything that they've got going on. I think they've got a lot of potential going forward, and I think even after everything that we look into that they've accomplished so far in 2020, we're going to see that there's a lot to look forward to in 2021 and beyond. So we're going to be going into Sonos' Q4 earnings report as well as their fiscal 2020 numbers. We're going to be talking about new products, new service offerings, record numbers, amazing guidance for 2021, and everything in between, guys. So let's not waste any more time. Let's get right into this video right after the intro. Alright guys, so to jump right into it, we've got this CNBC article pulled up here. I just wanted to give you guys a sense of how Sonos has been doing post having reported their Q4 and fiscal year results. This article reads here, Sonos soars after strong fiscal year revenue forecast. And this article came out the day that they published their earnings on Wednesday, November 18th. And I just wanted to read you guys this little section here. Says shares of speaker maker Sonos rose as much as 23% in extended trading on Wednesday after the company reported its fiscal fourth quarter earnings and fiscal year revenue guidance that beat expectations. For those of you that don't know, because I haven't really talked about that aspect of earnings reports yet on any of my videos, usually for any company that has analysts watching it, there are expectations and estimates that get put out for every quarter and every overall year that a company is in operations. So when it says that it beat expectations on fourth quarter earnings and revenue guidance, fourth quarter earnings is obviously the results of the fourth quarter, how they did, the revenue they brought in, if they brought in any profit, etc., etc. But guidance is something that companies do at year end. So this is year end for Sonos, fiscal end of 2020. So what revenue guidance is basically an estimate that the company puts out, projecting what their revenues are going to be for the total of the following year. So basically, it's estimates that Sonos has for their 2021 revenues. So not only did the fourth quarter earnings beat expectations, but the guidance that the company put out for 2021 came out higher than what analysts were expecting. So both across the board beats as far as expectations go for Sonos, which is pretty good to see as an investor. And then as we look here, how did the company do? These two key points I just wanted to read to you guys. Their earnings per share came out at 33 cents. When analysts in general were expecting 0 cents for this company's earnings. Revenue came in at $339.8 million versus general expectations of $298.8 million. So safe to say their Q4 did pretty good as far as beating analysts' expectations. Now to show you guys some of the price action with Sonos stock as a result of this pretty good Q4 and end of fiscal year. As you guys can see, I've got Robinhood pulled up here. As of right now, as of market close on Friday, Sonos is trading at $21.26. But as we take a 3-month step back here, we can see that prior to that Q4, pretty much all of post Q3 was trading between lows of 13 and change and highs of 16 dollars or so, leading up to November 18th when they reported earnings at the end of the day. So they reported after the market had already closed. They reported awesome earnings, and as a result, we have the next morning showing a new day for Sonos stock, moving up from $17 to $21, hitting a high of 22 at some point that day, but coming down after that, but staying in the $20 range. So ever since then, ever since they reported earnings, we've seen a steady $20 to $21 price point for Sonos stock, and I think we're going to continue to see its support there. We can see here my average cost still sits at $13.46 for Sonos. I've got 80 shares, so still the same amount of shares from the last time I reported on that, but now we are up 58% or so on Sonos stock, up about 624 bucks. But I plan on getting a lot more shares. I would honestly double my position if I could, because, you know, as we're going to see, there's just so much to expect and look forward to. I mean, this is only the beginning of the potential growth for Sonos as a company and as a stock. So that's the price action with Sonos stock, guys. Before we get into the cool stuff like their products and the new services that they're offering, new partnerships that they've got going on and things like that, let's go ahead and take the boring stuff and get it out of the way. We're going to look at the Q4 and fiscal year 2020 numbers that have all these investors excited and have them piling money into Sonos stock. Now, Patrick Spence, the CEO of Sonos, was on Yahoo Finance talking to everybody there pretty much, the day after that they had reported their earnings, kind of talking about the company and the earnings report and how everything's been going. And I thought it was important to point this out. Yahoo had this to say: the behavior changes, referring to consumer behavior changes, have brought this business to a key inflection point. That crossroads is where Sonos is likely able to drive more consistent financial performance, because as it says there, consistency was often an issue for the company pre-pandemic. For investors, in large part because of how people have altered their lives perhaps for years. And this is to quote Spence. He said, "We have hit an inflection point, and also an inflection point with profitability." And he couldn't be more accurate as we see these Q4 results here. This is focusing specifically on Q4. This is directly from their earnings report presentation. It says record profitability and strong revenue growth as we see the constant year-over-year change from 4Q18 to 4Q19 to now 4Q 2020, a significant growth there. And it reads revenue grew more than 16%. This is something that's important to take note of, though. You'll see there that it says excluding the 14th week. I'm not sure why this happened or what this means, but I guess they had a extra week in their quarter. I guess usually it's supposed to be 13 weeks. If you multiply that by 4, that's about a year. But I guess they had some extra week in their quarter, and that accounted for more than like half of the revenue growth. So that's something strange, something to look at. I've never seen that before, so I don't really know if that is something to look into deeper. But yes, overall, including the extra week, revenue grew more than 16%. And it says there that that was due to strong demand, success of recent new product intros, and 67% DTC growth. That stands for direct to consumer. So their quarterly direct to consumer growth was 67%, which offsets the negative impact of you-know-who on retail store partners and product availability constraints. So I had mentioned at the beginning of my video that the closing of retail stores made it difficult for Sonos to sell products, but really what we see here in this Q4 result is that that was not the case. Their direct-to-consumer channels grew 67%, and if you guys remember the last time I talked about Sonos' earnings report, their direct-to-consumer revenue was already on pace to grow a lot. I think that's very important to note, as we can see here in their letter to the shareholders from their earnings report, is that they saw record direct-to-consumer revenue. That's what that DTC means. And here we're seeing that it is continuing that strength. So the fact that retail stores closed during COVID and the Best Buys, the Targets, whatever, the places that held these physically in store, it didn't even matter because they're doing such a good job at growing their online sales, their direct to consumer. I mean, if you guys are Sonos product owners, you guys know the emails that they send out, the ad lists that they send out. I mean, they're doing a great job at getting the products to you without even needing the retail partners. So this is in itself an amazing standalone fact. To come back here, adjusted EBITDA growth was driven by continued strong demand, further growth margin expansion, and significant OPEX leverage. Now, when it says adjusted EBITDA growth, for those of you that don't know what that is, well, first of all, EBITDA stands for earnings before interest, tax, depreciation, and amortization. And what the goal of EBITDA is to kind of look at the company's earnings before these default expenses that kind of just come with business, but that don't really have anything to do with the operations of the company. So a company, just by doing business, is going to end up paying interest, is going to end up paying taxes, depreciation, things like that. But those don't really have anything to do with the operational side of things, the revenues, the cost of goods sold, and how good the company is at profitability in that sense. So when someone says, let's look at the EBITDA growth, they're saying, let's look at the earnings of the company without accounting for things like interest, taxes, depreciation, and amortization, so we can kind of see how they're doing with their operations. And this is just a metric for looking at a company in a different way. No one obviously would ignore those kind of things. Investopedia says it well here when it explains how EBITDA is used. It says, no analyst or investor would argue that a company's numbers or interest, taxes, depreciation, and amortization are irrelevant, because they very much are relevant. But nevertheless, EBITDA strips all of those numbers out in order to focus on the essentials: operating profitability and cash flow. So for the sake of EBITDA, you ignore expenses like interest, taxes, depreciation, and amortization, and you look at a company's operation profitability. Adjusted EBITDA margin is a little bit more complicated, so we won't get into that one right now. But moving on to gross margin. Gross margin was a record 47.5%. Excluding tariffs, gross margin grew by 560 basis points to be about 48.3%. Now, what gross margin does is it takes an overall look at the company, and it basically tells you how much does this company make on every dollar of sales. So how profitable is this company per dollar? So the higher the gross margin, the more a company makes on every dollar, the better they are operationally and the more profitable they are. So to give you an example, if a company has 70% gross margin, that means on every dollar of sales, they're keeping 70 cents. That is a very profitable company. But on the other side, if a company has 30% gross margin, then they're only taking home 30 cents on every dollar of operations, so they're operating very expensive. So for Sonos to show gross margin of 47.5 and 48.3 if you were to exclude tariffs, Sonos is almost at 50% gross margin, almost taking home 50 cents on every dollar, which is crazy, guys. That is great. I mean, some companies never even get to that kind of gross margin. So for them to be growing at this pace and to expect even more growth going on into 2021, very exciting for Sonos investors. Let's move on. So we've already gone ahead and looked at some of the key highlights from Sonos's Q4 report, mainly the steady growth of revenue, the record gross margin, and continued growth of adjusted EBITDA. Now let's go ahead and look at some of the main highlights from the full fiscal 2020 and some of those main things that have people excited looking forward into 2021. All right, guys, so I've got Sonos's Q4 and fiscal year release here. We're looking at the fiscal year 2020 highlights. So as we look here, I think this is probably one of the highlight details of the year. This marks the 15th consecutive year where Sonos saw 20+% household growth. That puts them at a cumulative 10.9 million households to wrap up the fiscal 2020, compared to last year where they wrapped up the year with 9.1 million households. That marks a 20% year-over-year change. So pretty amazing growth there. And what's even more amazing is their percent registrations to existing households. What that means is their existing households accounted for 41% of new product registrations, up from 37% last year. So Sonos customers are going out of their way to buy even more Sonos products, making it an average number of registered products per household of 2.9, guys. So Sonos customers are very happy with the products, so much so that they're going out of their way to buy more than one, putting them in different rooms of the house, probably getting a full system going on. So, and this seems to be a trend that is growing, as we saw here. So the year-over-year difference here is about 4%. Hopefully that's to continue and maybe be a new trend for Sonos customers, where they continue to just fill their house with different Sonos products and just continue to expand on the love for that brand. In total, we have got listening hours up 33% on top of 29% last year, making that 10.2 billion listening hours to wrap up fiscal year 2020. Incredible data points there for Sonos. As we come down here, we see demonstrating significant scale and profitability. Here we get a better outlook of the full year revenue from fiscal year 18 to fiscal year 20, where we are today. Revenue grew more than 5% to 1.326 billion, as we see here. But if we were to exclude that odd 53rd week that I talked about, revenue would really only be up about plus 3%. So again, there's that odd detail mentioned there. Adjusted EBITDA on a full fiscal year basis is up more than 22%. If you were to exclude tariffs, though, the adjusted EBITDA is up more than 56%. So that is a crazy detail there. Speaking on excluding tariffs, the CEO, Patrick Spence, actually had something to say about that on his Yahoo Finance interview.
How the tariffs have impacted your business over the past 12 months. What's your hope with regards to tariffs in the incoming Biden administration?
Well, the best news, Brian, is that we have actually put those behind us because of our diversification in our supply chain. So now that we're up and running in Malaysia, tariffs are not an issue for us in fiscal 21. So we've done what we can and what's in our control. And we'll let the voters decide and the government decide what they need to do on the policy front, whatever's best for the country. But the good news for Sonos and for our investors is that we've put those behind.
So throughout this earnings report, you'll see, X tariffs mentioned a lot. If you were to exclude tariffs, this is what it would have been like. If you were to exclude tariffs, this is what it would have been like. Well, it's nice to see now that tariffs is something that they've, according to Spence, put behind them, like he said. We'll see what that means in quarters to come, but hopefully that means that we'll see a lot more growth, not having to worry about the tariff expense that the company was facing. Gross margin is up to 43.1%. Again, if we were to exclude tariffs, 45.6%. So just very nice steady growth. Sonos now has free cash flow of $129 million versus $97.4 last year. To get a better look at their cash versus debt situation, their free cash flow, like we said, is sitting at $129 million now. Ending cash and cash equivalents, very important detail there. So the cash that they currently are ending the year with, they've got $407 million in cash and cash equivalents. Long-term debt is down 26% year over year from $24.8 million last year to $18.3 million this year. Perfect situation for Sonos to see their cash growing and their debt decreasing. Amazing overall fiscal 2020 numbers for Sonos, guys. As we look forward to fiscal year 2021, finally we're going to take a look at the details that have people excited going forward and why I think there's still a lot of room for investors to get into Sonos stock. As we see here, the priorities that Sonos has going into 2021, very important. They're very focused on delivering innovative new products that both new and existing customers will love. Now this detail is one that I think we'll get more info on very soon, like as soon as March of 2021. And I'll bring that back up in a bit, but this is something I'm very excited about. They're focused on their services that will enhance and further differentiate the customer experience, also very important. Strengthening their direct-to-consumer efforts even more, supporting our incredible partnerships, adjusted EBITDA margin expansion. They want to continue leading in gross margins, and they want double-digit revenue growth to continue going forward. So amazing priorities. Obviously, every company wants to do things like that. But what's special about Sonos is their particular ability to deliver on these things now. If we move down here, we get a look at the numbers that they have expected for next year. So adjusted EBITDA for fiscal year 2020, we saw $108.5 million of earnings, EBITDA adjusted. They expect to see $170 to $205 million in adjusted EBITDA earnings next year. So that is stellar growth, guys. I mean, that is going to be, and this might even be lowballing themselves. If the new products and services that they offer do as well as I think they'll do, I mean, we're expecting to see some great growth. Gross margin, we saw 43.1. They're expecting about 45.3 to 45.8. So they're looking at 45% gross margin going into next year. Revenue for the fiscal year this year, right? We saw it was 1.326 billion. They're expecting 1.44 to 1.5 billion. That's going to be a percentage growth of about 11 to 15%. Even if you exclude or include that 53rd week, revenue growth is going to be pretty amazing, guys.